The tape is lagging the real market, and silver is starting to expose it in a way you can't unsee. Because when a metal can rip into record territory and still feel scarce at the edges, that's not emotion. That's a system getting forced to reprice. And the pushback you're hearing right now, the casual dismissals, the it's just another spike, the it'll fade by lunch, that's not analysis. That's defense. Defense from a market that prefers silver to behave like a sleepy cousin of gold, not a volatility grenade with industrial teeth. Stay with me, because the payoff in this video is not a vague, bullish story. You're getting a concrete next 2 weeks roadmap. The levels that matter, the calendar window that can whip price around violently, and the one underappreciated detail that explains why this move is happening the way it's happening. Here's the first thing you need to accept if you want to read silver correctly. The open is not a neutral moment. The open is a test of who actually has liquidity, who only had confidence, and who is about to discover the difference. In the first minutes of a session, spreads can widen, stops are clustered, and the top of the order book is thinner than people think. That's why silver doesn't always trend at the open. Sometimes it jumps, sometimes it gaps, sometimes it prints a level and immediately dares the market to defend it. And that's where the real pressure starts. Because when price moves in blocks, not steps, you're not watching a calm auction. You're watching participants being forced to make decisions they didn't want to make today. Now let's put the current context in plain language. Silver has been swinging hard, and we've seen it push into record prints around the low to mid 80s, with violent intraday ranges that don't feel like a normal risk-on, risk-off day. That kind of movement is the market telling you something. Not that every candle is true, but that the regime changed. Volatility itself becomes part of the mechanism. It changes hedging behavior. It changes margin behavior. It changes how dealers quote size. It changes how people sleep. But that's not the part that matters. The part that matters is what usually sits behind these kinds of repricings. The structure, the plumbing, the incentives, the forced flows, the bottlenecks that don't show up in a headline. So let's drop the hidden detail right now, early, because it reframes the whole story. The silver market isn't screaming because the world ran out of silver overnight. It's screaming because the silver is in the wrong places, in the wrong forms, with the wrong owners, at the wrong time. Location, access, deliverability. Those 3 words are the difference between a calm market and a market that starts throwing its weight around. You can have a big headline number for inventories and still have a tight market if that inventory isn't isn't actually available to meet the type of demand that S showing up. That sounds subtle. It's not. It's brutal. And if you get this one concept, you'll start seeing why silver can spike fast, retrace hard, then rip again without contradicting itself. Because it's not a single market. It's a chain of linked markets, and the weakest link sets the tone when stress hits. Here's what most people miss. Paper silver can be created, traded, and hedged instantly. Physical silver can't teleport. It has to be refined. It has to be assayed. It has to be transported. It has to fit the standards of whatever market is demanding it. And it has to be financed. That last part is quietly massive. Because even when metal exists, moving it through the system costs money, takes time, and requires balance sheets. When financing gets tight, or when vault preferences shift, or when a region starts pulling metal in faster than the system can refill it, you get friction. And friction is what turns an orderly curve into a stressed curve. The next detail is what flips the whole setup. The benchmark price can look fine while the spreads start screaming. That's why people who only watch spot get blindsided. Spot is a headline. Spreads are the confession. Let's talk about the street symptom, because it's the easiest way to sense stress without needing a terminal. When physical markets get tight, you see behavior changes before you see clean data. Dealers widen premiums. Availability gets inconsistent. Delivery times stretch. You start seeing pre-sale language, or the sense that supply is being rationed. Is every anecdote gospel? No. But as a cluster, those frictions matter. They're the smoke. And the smoke tells you where the fire is likely to be before the official report shows up. And that's where the market psychology gets dangerous, because people will dismiss these signals as retail noise. Meanwhile, the professionals are watching the same thing through a different lens. Watching how it forces participants to behave. If metal is harder to source quickly, that changes the cost of shorting. It changes the risk of delivery. It changes the willingness to warehouse. It changes the role. It changes everything. Now, we're going to make this simple, because silver traders love to sound complicated right before they blow up. Paper versus physical is not a conspiracy story. It's an incentive story. Futures markets exist to allow hedging and price discovery, yes, but they're also leveraged arenas. The majority of activity is not, I want a bar. It's, I want exposure or I want a hedge. Oh, that's normal. The problem is when a leveraged arena is asked to reflect physical urgency in real time. because if physical tightness rises, the market has to decide, do we adjust price or do we adjust constraints? And usually it does both, violently. But that's not the part that matters. The part that matters is how the front end of the curve behaves when urgency shows up. So look at the term structure. In calm markets, you often see a pretty normal curve where deferred prices reflect financing and storage and time. When stress hits, nearby contracts can get bid relative to later ones. That's the market saying, I need metal now, or I need to secure exposure now, not later. And when the front end starts pulling, it can create a chain reaction. Because spreads force behavior, if the roll becomes expensive, some participants reduce positions. Others chase nearby exposure. Others source physical. Others step away from making markets. And the moment market making steps back, volatility accelerates, and that's where the real pressure starts. Now let us address one of the most misunderstood pieces of inventory talk, vault holdings. People see a big number attached to London vaults or some other reported category, and they assume comfort. They assume that means plenty. But reported holdings are not the same as deliverable supply that can be mobilized on demand at a price that doesn't break the market. Some of that metal is owned by entities that don't care about lending it. Some is tied up. Some is held against obligations. Some is simply not willing to move at the current price because the owner expects a higher price. Inventory exists, but availability is behavior, and behavior changes fast when the macro backdrop changes. Because if the world starts pricing in currency stress, policy uncertainty, or geopolitical shocks, metal stops being a commodity and starts being an insurance asset. And insurance assets done at T come back onto the market just because someone says it misoverbought. Now zoom out. The story silver is telling right now has multiple layers, and if you rely on one layer, you'll get trapped by the first pullback. So we're going to stack proof like a courtroom, not a tweet. First layer, chart structure. Silver pushing into fresh records and moving in wide ranges is a regime shift signal. Second layer, market structure. Opens and thin liquidity create jumpy repricing, and that's exactly what we've been seeing. Third layer, term structure and spreads. The front-end behavior matters more than spot headlines because it signals urgency. Fourth layer, supply chain reality. Silver supply can't just ramp instantly because a large portion is byproduct from other mining. Fifth layer, regional pull. When one region pulls metal hard, especially if it's tied to investment demand, strategic stockpiling, or supply chain hedging, it creates a vacuum that pulls on the global benchmark. Sixth layer, the calendar. There's a very specific why now trigger that can distort price action over days, not months. And if you don't know it, you'll misread the tape. Because if this one window is active, the math changes. Let's talk about the calendar catalyst, because this is where people make emotional decisions and then blame manipulation when it was actually mechanics. We're in a period where commodity index rebalancing can create forced selling or forced buying, depending on how weightings shift and how funds execute. That matters because those funds are not discretionary in the way retail imagines. They don't wake up and say, I feel bearish today. They say, I must rebalance. Wait over. And when a forced flow collides with a thin liquidity moment, it can create a move that looks wrong in the short term. You can get a sharp dip even in a structurally bullish environment. You can get an air pocket. You can get stop cascades. Then, once the forced flow is done, the underlying tightness reasserts itself and price snaps back. That's not a guarantee. It's a pattern. It's how mechanical flows collide with fragile liquidity. And the next detail is what flips the whole setup. When you see a violent move during a known forced flow window, you should treat it as a signal about positioning and liquidity, not as proof that the thesis is dead. Now layer in macro. Silver is not only a metal, it's a macro instrument with an industrial engine. That's a weird mix, and it's why it behaves differently from gold at key moments. Gold can trade like pure insurance. Silver trades like insurance that also has a factory behind it. That means when the dollar weakens, when real rates shift, when inflation expectations churn, and when policy credibility gets questioned, silver can catch a bid. But it can also overreact because it's smaller and more sensitive to flows. Add in geopolitical stress, currency tension, and the broader trust environment, and you get a situation where metals stop being just another trade and start being a positioning statement. And positioning statements attract crowds. Crowds attract volatility. Volatility attracts hedging. Hedging can attract more volatility. That's reflexivity, and silver is especially good at it. But that's not the part that matters. The part that matters is who gets forced to act when volatility spikes. Here's how a squeeze actually forms, without romance. A squeeze is not a villain story, it's a balance sheet story. When price rises, shorts face losses. Losses trigger margin requirements. Margin requirements force either more capital or less exposure. If a participant can't or won't post more margin, they reduce the position. Reducing a short position means buying. Buying in a thin market pushes price higher. Higher price increases losses for remaining shorts. That triggers more margin pressure. This is not psychology, it's arithmetic. And it gets amplified when options positioning is involved, because dealers hedge dynamically. If call demand rises, or if price moves into zones where dealer hedging changes direction, you can get mechanical buying that feeds the move. That's not a promise, it's a mechanism. And the next detail is what flips the whole setup. Once a market enters a forced buying loop, it can overshoot fundamentals in the short run and still be explained by structure. That's why you don't trade silver like a slow macro ETF. You trade it like a market that can punish certainty. Now, let's ground this in the supply chain, because people love to say, just mine more. That's not how silver works. A lot of silver supply comes as a byproduct of mining other metals like copper, lead, zinc, and gold. So even if silver prices jump, that doesn't immediately create a wave of new primary silver mines. It changes economics at the margin, yes, but the lead times are long. Permitting takes time. Construction takes time. Refining capacity has constraints. Assay and logistics are not instant. Recycling helps, but recycling also has a ceiling in the short term and often responds with a lag. So when demand spikes, especially investment demand, supply can't sprint to catch it. It jogs, slowly. Meanwhile, the market reprices now, and that mismatch between financial speed and physical speed is the core tension. But that's not the part that matters. The part that matters is how this tension shows up in prices people can actually trade. So let ES talk about arbitrage and why it is not the magic fix people assume. In theory, if one region pays a premium, metals should flow there and prices should converge. In practice, arbitrage has friction: shipping, insurance, financing, assaying, vault acceptance, and timing. And timing is everything. If the demand is urgent, a slow arbitrage doesn't relieve stress quickly enough. That means regional premiums can persist longer than people expect. And when they persist, they tug on the global benchmark like gravity. This is the part the mainstream often misses. The headline price can look like a paper number, but persistent premiums and tightness create a slow pull that eventually shows up in the benchmark. Sometimes it shows up as a grind. Sometimes it shows up as a snap. And when it snaps, people call it sudden. It wasn't sudden, it was delayed. Now add one more layer that matters right now: policy and trade fragmentation. When export rules shift, when trade flows get constrained, when a major player signals tighter control over strategic materials, it doesn't just change supply, it changes the map of liquidity. Liquidity is not evenly distributed. If a region becomes harder to source from, the market starts paying up elsewhere. That creates new choke points. It changes who has bargaining power. It changes which vaults matter, and it changes how quickly stress can spread. You don't need to claim certainty about motives to see the effect. Fragmentation increases volatility. It reduces the ability of the system to smooth shocks. It makes silver behave less like a single global pool and more like a set of connected reservoirs with valves that can stick. And that's where the real pressure starts. Now I want you to be very clear on something, because it's your psychological shield. Silver is the kind of market that will try to make you emotionally wrong even when you are redirectionally right. It will whip around violently. It will print scary wicks. It will run stops. It will bait you into chasing. Then it will punish the chase with a sharp pullback. Then it will rip again the moment you swear it's over. This is not personal. It's a function of positioning, liquidity, and reflexive hedging. Your job is not to predict every tick. Your job is to separate trend signals from noise. Trend signals are structural: breaks, retests, persistent spread stress, consistent evidence of tightness. Noise is the intraday chaos created by thin liquidity, forced flows, and headline reactions. If you treat noise as truth, you'll hand your decision-making over to the worst part of the market, the part designed to harvest impatience. So here's the 2-scenario lens you need for the next 1 to 2 weeks, because it keeps you honest and keeps you from falling in love with a single outcome. Scenario 1 is the controlled pullback and retest. In this scenario, silver cools off from the record push, revisits a key zone, and tests whether buyers show up without needing a panic. Think of it like the market checking its own work. Volatility can still be high, but the structure remains constructive if pullbacks are bought. And if the market holds a meaningful support zone rather than slicing through it like it was never there. Scenario 2 is the continuation squeeze. In this scenario, dips don't get the chance to form cleanly. Price pushes, gaps, and forces late hedgers and shorts to buy into strength. That's where gap risk lives. That's where overnight headlines matter more. That's where a small market becomes a loud market. And the next detail is what flips the whole setup. The same evidence can exist in both scenarios, but the difference is how the market behaves around key levels and around the calendar. Let's make those levels practical without pretending we can pin the exact dollar like a prophecy. When silver prints into the low to mid-80s and tags record territory, that zone becomes memory. Markets remember, Even if price pulls back, the question becomes, do we hold above a psychologically important round zone and build acceptance, or do we reject and fall back into the prior range? A battle zone around the low 80s matters because it is where late buyers and early sellers negotiate. If price holds that region on a retest, it suggests the market is building a new floor. If price slices below and cannot reclaim it, the tape may be telling you the move needs more time or a deeper reset. Below that, you're rewatching prior congestion zones in the upper 70s and mid 70s as areas where the market either proves demand is real or reveals that the move was mostly flow driven. This isn't fortune telling, it's risk framing. Because if this one level breaks, the math changes, and you need to know in advance what changes the math means for you, not after the market humiliates you. Now let's connect those levels to real mechanisms. If you see a pullback during a known forced flow window, like index rebalance activity, you should be cautious about labeling it bearish. It may be mechanical, it may be liquidity driven, it may be stops getting triggered in a predictable manner. The confirmation is what happens after the window passes. Does the market stabilize and reclaim key zones? Do spreads remain tight? Do physical symptoms persist? Does volume behavior suggest capitulation or absorption? That's the checklist, not your feelings, not someone's viral clip. The next detail is what flips the whole setup. If price remains resilient, even while forced flow tries to push it around, that's often a sign the underlying demand is strong enough to absorb pressure. That absorption is the quiet signature of a market repricing. And since we're talking about trust, let's address the institutional behavior angle without sliding into cartoon certainty. Institutions don't need to manipulate to create strange moves. Their incentives alone can do it. Funds have mandates. Dealers manage risk. Banks manage balance sheets. Producers hedge. Consumers hedge. Each of those actions can create pressure at specific moments: opens, expiries, rebalance windows, delivery periods. When silver is calm, those pressures get absorbed. When silver is stressed, those pressures become the move. So instead of asking, who did it? Ask, what does this force participants to do? Because that question gives you actionable information. If a dealer is short gamma, they may have to buy as price rises. If a fund must rebalance, they may have to sell regardless of the narrative. If a short is margined, they may have to cover at the worst possible time. If a physical buyer faces longer lead times, they may pay up and lock in supply. That's the real story, and that's where the real pressure starts. Now we need to be honest about uncertainties, because that's how you keep trust with a skeptical audience. There are counterpoints. Volatility can be mean reverting. A sharp spike can invite profit taking. Macro conditions can change fast. If the dollar rips higher, if real yields rise, if risk sentiment shifts, metals can get hit. If policy news cools, safe haven demand can fade. And if the move was heavily driven by short-term flows, you can see a sharp retrace. None of that invalidates the structural argument by itself. It just means you must watch confirmations, not narratives. If spreads normalize, if physical premiums cool meaningfully, if the curve relaxes, that could signal that the tightness was temporary, or that the system successfully mobilized supply. If price fails to hold key zones and momentum collapses, that weakens the near-term squeeze story. That's how you stay credible. That's how you stay solvent. Because silver is the kind of market that will punish anyone who speaks in guarantees. So what should you watch next, specifically, in the next week or two? First, the behavior around those key zones. Does the market accept above them, or does it reject and fail to reclaim? Second, the character of dips. Are they shallow and quickly bought, or do they drift and feel heavy? Third, the open and the close. Silver loves to reveal intent at the edges of the session, where liquidity and positioning collide. Fourth, the calendar. Watch how price acts as forced flow windows pass, and watch how the market behaves around option-related moments and delivery-related moments. If we see a sharp, ugly move that coincides with a known mechanical period, you treat it differently than a breakdown on a quiet calendar. Because the market is not a morality play, it's timing, and it's pressure. Now I want to give you a simple mental model that keeps you from getting whipsawed into bad decisions. Imagine the silver market as a network of pipes. Paper markets are high-speed pipes. Physical markets are thicker pipes with valves and friction. When demand surges or supply tightens, pressure rises in the network. Sometimes the pressure releases through a clean price rise. Sometimes a valve sticks. Logistics, financing, location, and pressure builds until it releases suddenly. Your job is to watch the gauges that reflect pressure, not just the water level. The gauges are spreads, curve shape, and real-world frictions. And when those gauges stay elevated, it tells you the system is still under strain even if spot pulls back. But that's not the part that matters. The part that matters is what you do with that information. You don't need to predict the next candle. You need a process that doesn't break when the market tries to break you. Here's your psychology shield in practice. When silver rips, your brain screams, "I'm late." When silver dumps, your brain screams, "I'm wrong." Both screams can be false. This is why professionals predefine their conditions. They decide in advance what confirms, what weakens, and what invalidates. They decide in advance how much volatility they are willing to tolerate for the time frame they are retrading. If you're watching silver like a macro signal, you can accept more noise. If you're trading it tactically, you need tighter definitions. Either way, you respect that silver can whip around violently even if the broader thesis is correct. That's not a disclaimer, that's the game. And if you ignore it, you'll become the liquidity for someone else's exit. Now let AS bring it home with a clean checklist you can actually use without turning this into a lecture. If silver holds the post-spike battle zone on pullbacks and reclaims quickly after mechanical sell windows, that supports a repricing regime. If silver can't hold and we see persistent rejection with spreads calming and physical frictions easing, that suggests the move may need more time or a deeper reset. If we see continuation behavior, gaps, shallow dips, strong closes, that's the squeeze scenario trying to assert itself. In that squeeze scenario, you should respect gap risk and not assume you'll get a friendly entry. In the controlled retest scenario, you should respect stop hunts and not confuse a wick for a collapse. Either way, you're watching the same thing. Does the market behave like it's being forced, or does it behave like it's relaxing? Because that one difference tells you who's in control. And here is the subtle part that separates people who just consume narratives from people who build an edge. You don't need to be right about every explanation. You just need to be right about what the structure implies. The structure right now implies sensitivity. It implies that location and deliverability matter. It implies that forced flows can distort short-term price without changing the bigger picture. It implies that silver can reprice fast because physical can't move fast. It implies that when volatility rises, the market itself becomes a catalyst. And it implies that the open can be a trap for anyone who assumes liquidity is always there. The next detail is what flips the whole setup. If you start watching spreads and curve behavior instead of just spot headlines, you'll see stress early and you'll stop getting emotionally hijacked by the loudest candle. So if you're here for the what do I do angle, here's the most honest answer. You manage risk first. You respect that this market can be violent. You define your time frame. You define your invalidation. You don't marry a position. And you don't let a single day's chaos talk you into abandoning your process. If you're a macro watcher, you watch whether the market keeps building acceptance above key zones and whether the evidence of tightness persists. If you're tactical, you watch the opens, the closes, and the reaction to key levels, especially around known calendar events. And you never forget that silver is a market where the crowd gets punished for certainty. One last thing before we close, because this is the identity piece, and it matters. The difference between getting used by volatility and using volatility is community and process. Not hype, not promises. Process. If you're the kind of investor who wants mechanisms, not slogans, if you want to understand what forces other participants to act, then you're already in the right tribe. Stay with that. Build your checklist. Watch the curve. Watch the behavior around levels. Watch the calendar. And when the market tries to shake you out with noise, remember the real signal is in what the market is forced to do next. Because silver doesn't have to be your biggest position to be your best teacher. It only has to be honest. And right now it's being brutally honest.